Hey guys! Welcome back to another episode. Today we will be talking about spending and tax multipliers. Let's get started. Before we discuss specific multipliers, you need to know about the propensity to save and consume. The term propensity means a tendency to do something, and in this case, we're going to look at the propensity to save or tendency for consumers to save, and the propensity or tendency for consumers to spend or consume. The average propensity to save is the percentage of all income that a consumer or a group of consumers saves. The formula is the amount of savings divided by the disposable income. The average propensity to consume is the percentage of all income that a consumer or a group of consumers spends. The formula is the amount of spending divided by the disposable income. When you add the average propensity to consume and average propensity to save together, you will always get 1, and that's because after paying taxes, there's only 2 things a consumer can do with their disposable income: spend and consume, or save. Let's see an example. Suppose an individual received $100,000 in disposable income after paying taxes and they save $20,000 and spend the rest of the $80,000. The APC would be the $80,000 consumed divided by the total $100,000, giving us 0.8. This means that 80% of the income is being consumed. The APS would be the $20,000 saved divided by the total $100,000, giving us 0.2. This means that 20% of the income was saved. We can also see here that the APS plus APC equals 1. While understanding average propensities to save and consume is necessary, the more important concept in this topic is the marginal propensity to save or consume. The marginal propensity to save is the percentage of new income that a consumer or a group of consumers saves. The formula for this is the change in savings divided by the change in disposable income. The marginal propensity to consume is the percentage of new income that a consumer or a group of consumers spends, and the formula for this is the change in spending divided by the change in disposable income. If you recall, marginal means change in the total, so the marginal propensities focus on the change in income versus the change in spending and saving, rather than total income versus total spending and saving. Similar to the average propensity to save and consume, the marginal propensity to save plus the marginal propensity to consume will always equal 1 because saving and consuming are the only 2 things a consumer can do with their disposable income. Let's use another example. Say a person's income increased from $100,000 to $150,000, and the amount put into their savings increases from $20,000 to $35,000. To find the marginal propensity to save, we must determine the change in the values. The income changed by $50,000 and the savings changed by $15,000. Plug that into the equation and you get a marginal propensity to save of 0.3. This means the person saved 30% of their marginal income. And since marginal propensity to save plus marginal propensity to consume equals 1, we can figure out the marginal propensity to consume by subtracting the marginal propensity to save from 1, which gives us 0.7. Using our knowledge of marginal propensities to save and consume, we can begin discussing the spending multiplier. But first you need to know about the multiplier effect that occurs when an initial change in spending is magnified in an economy, leading to a much larger change in real GDP than the initial change. For example, let's say a business increased investment in robots by $1,000 and the marginal propensity to consume in the entire economy is 0.8 and the marginal propensity to save is 0.2. The robot manufacturer receives the $1,000, saves 20%, and spends $800 on materials. The supplier saves 20% and spends the $640 on a new TV. The TV seller saves 20% and spends the rest, and so on. As you can see, the initial $1,000 increase in spending has now multiplied and become much more spending that will be added to the GDP. But that's a lot of math to do, so that's when the spending multiplier comes into play. It's used to identify the total change in GDP we will see after the initial spending. The formula for this is 1 divided by the marginal propensity to save, or 1 divided by 1 minus the marginal propensity to consume. 1 divided by 0.2 gives us a spending multiplier of 5. So if we multiply the spending multiplier by the initial change of $1,000, we can figure out that there would be a maximum $5,000 increase in GDP from the initial $1,000 increase in spending. The multiplier works the same in reverse. A $1,000 decrease in investment would decrease GDP by a maximum of $5,000. Just as changes in spending multiply through the economy to have a larger impact on GDP, the impacts of changes in taxes on GDP are also magnified. The tax multiplier is used to determine the maximum change in spending when the government changes taxes. The formula for this is the negative of the marginal propensity to consume divided by the marginal propensity to save. Using the marginal propensity to consume and marginal propensity to save from the last example, we get a tax multiplier of -4. So a $1,000 decrease in taxes would increase GDP by a maximum of $4,000, and a $1,000 increase in taxes would decrease GDP by a maximum of $4,000. The tax multiplier is always one less than the spending multiplier. This is because spending multipliers have an immediate impact on the economy, but tax multipliers first have to go through someone's income before having an impact on the economy, and sometimes, tax decreases are saved rather than spent. That's the end of this episode. Thanks for watching, and we'll see you in the next one.